Well, welcome to our High Rock Monthly video. I'm Scott Thomason, and with me today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock's certified financial planning professional, Bianca Tomlinson. Well, February, Paul, was an interesting month, especially the last week, right?
and this week starting out, or this month is starting out equally as interesting,
isn't it? And we watch all the selected financial markets very closely, but certainly at one point the S&P 500 was down close to 9% at the end of February. Again, it's been a very volatile time, and as we can see here, looking at volatility spikes since 2000, basically since 2008, you can see how it compares. So it's definitely up there with the likes of what happened in 2018, 2015, and those all generated some pretty reasonably good buying opportunities for us. So, and we'll get to that in just a second. But Paul, let's talk a little bit about our portfolio. We have been positioned defensively for quite some time. We've made that fairly clear to everybody. And now,
given what's happened in capital markets, people know why.
Yeah, exactly. And we'll talk a little bit more about that. But here's a typical client portfolio that is, you can see with the target weights above each of the respective models that it is in that general 60% equity, 40% fixed income type of portfolio. And even still, with the last week, and we did add, Paul, we added somewhere in the vicinity of between 5 and 7%, depending on the client portfolio, of course, to our global equity model. So there was some value that we decided to take advantage of, and maybe I'll turn it over to you to talk a little bit more about that.
Sure, we could go through. Why don't we go through on this slide here, Scott, all three models and any sort of changes over the past month. So fixed income, we didn't really have a lot of changes in the portfolio. We added a very small position in new corporate bond. Unfortunately, we got a very small fill. It was, I sure would have liked to have gotten a better fill, but one large holder took the bulk of it. But that was in Auto Canada, which is a retail car dealership business across the country. It was a pretty impressive deal. Anyway, that was about the only addition. But really, I would just highlight in the fixed income model that we've been pretty close to fully invested. We have 4 very good and strong protective positions, and those 4 positions, well, 5 actually now, we added a pretty good size weight in 2-year Government of Canada bonds. Those don't have a huge price effect, but they've moved pretty substantially over the past week and a half, and especially even today with the rate cut out of the Bank of Canada, which we'll talk about in a minute, I'm sure. But most notably, we have what's called duration or longer dated bonds, both 10-year and 30-year, and we own them both in Canada and in the US. And they've done extremely well, even outside of the past week and a half. But over the past week and a half, they've really ramped up in price and lower in yield. We think that trend will continue, and we do want to own that as part of our balanced portfolio. Moving to global equity, Scott, as you mentioned, we did add about 5 to 7%, depending on the client positions at the time. We had stated this to most of our clients that we would be prepared to buy weakness, and this is part of what we were looking for. You know, the last week, U.S. stocks were down about 13% or so on the week. So we bought on the big down days. I think probably, I can't remember exactly, Scott, maybe Monday and Friday for sure, maybe 1 or 2 other days. But those are the really big down days, and we did do some buying. So we're pretty happy with that. And tactical model, that's where the ACQ bond actually sits. We've been continuing to sell out of our True Leave bond. We own a very small weight in that. We totally sold out of our Chemtrade, which was a big dividend-paying stock, which I'm not 100% sure right now, given what's going on in Canada, especially with transportation rail issues for Chemtrade, whether they're going to be able to pay that dividend or not. It's a really stout dividend, north of 12% right now. We continued to sell some of our smaller microcap positions that just did not really generate returns for us, Hudson Resources being another one. We had a really good trade. Our largest equity position, single equity position in the portfolio, which is Yellow Media, the old Yellow Pages. We sold out of about 25% of our holding, up around 12%, and that stock, Scott, got up to 13 and a quarter, and right now it's trading south at 10%. So I'm tempted to buy some back. It's held. There are 4 large institutional holders that own about 83% of the stock. So it can be rather whippy at times, i.e. volatile and illiquid. But it's I still quite like that one. So I'm happy we sold, took some profits on some of it, and may look to rebuy those shares back. And the final thing in the tactical, Scott, is we initiated a very small position in CIBC stock, Canadian Imperial Bank of Commerce. So we'll look to add to that. That's north of a 5.5% dividend yield. We'll look to add to that, but it seems like it's broken down a little bit here from where we bought it, and I want to watch it a little closely and see if we can buy it a lot cheaper. So those were the major changes in the models over the past month.
Excellent. Well, we kept Bianca busy allocating most of the end of last week and the beginning of this week. So we know there's been a fairly significant amount of activity in our client portfolios. But one of the reasons we try and have tried to be as defensive as we can is in anticipation of what we never anticipated that we would see the coronavirus impact markets. But we knew that the economies were at the late stage of the cycle, and obviously the coronavirus is having that impact. But something that our 60-40 portfolios or thereabouts, the clients would have seen pretty minimal downside impact on a year-to-date basis. We've seen stock markets down 6, 7, 8%, and we're seeing less than 0.75% for a basic 60-40 portfolio and to the downside, and a portfolio that obviously was significantly more fixed income. A 60% fixed income portfolio, for example, is still quite positive on the year and has had a pretty decent return, and that's obviously because of the bond holdings, and that certainly has been helpful. But we remind our clients that we are always monitoring and keeping our focus on the long term. But if we can minimize or mitigate the downside impact on a portfolio, that means that the recovery time for that portfolio is also shorter, and it bounces back more quickly. And certainly that's one of the things that we're trying to accomplish here. Get a portfolio back to its growth trajectory as quickly as we possibly can. All right, Paul, what is keeping us up at night? Well, certainly we know that it is, one thing is the coronavirus and all of the things that have been happening around that. We have seen today that in the U.S. especially, we're starting to see more cases come to light. So it is starting to pick up a little bit in North America. One of the things that struck me, and I saw earlier today in the news, that Italy is shutting down all its schools and daycare, and 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 in that kind of a circumstance, you have to wonder how the economy is going to be impacted, because if people don't have daycare, they can't go to work if their children have to be at home. So there's all sorts of repercussions that we're going to see. People aren't going to be able to the consumer is going to be limited, and there's going to be a lot of impact on those things. There are so many uncertainties right now, and I think you can comment too, but I think that's the big risk that is out there right now.
Yeah, I think just with regards to the coronavirus, there are probably two effects that will affect the global economy. And I think the first one is supply chains. As everybody knows, over the last 20 years, China has become the manufacturing base for the world with obviously cheap products. And even with the Trump administration moving some manufacturing back to the US, China is still a huge exporter of manufactured goods. So that supply disruption, as China what has over the past month, slowed down production, that's going to be problematic. And then I think the other one is really just tourism, travel, et cetera. I can't remember which U.S. airline just said they were sharply reducing capacity. I mean, Air Canada stock has gone from 50 to 33. It's back up a little bit now, but it's been hit really hard, as has their it's a separate company, but their operator Rouge, which everybody's familiar with. That stock, which we used to own in the past, is off about 30% as well. So I think those are the two big ones that will really affect things. And I'm actually on a call tomorrow morning, late morning. National Bank calls hosting an infectious disease expert doctor from St. Mike's on a call. It'll be kind of interesting to hear what he has to say, but I've heard a few infectious disease doctors. Some have been rather draconian in their view, but when the market has uncertainty involved, it tends to be very volatile, both to the upside, because there's a fear of missing out on rallies like today and yesterday. It's fear to the downside.
All right. Well, the U.S. Federal Reserve cut interest rates yesterday, and obviously it's for security purposes, but the market didn't take it so well yesterday, and that was interesting in and of itself. But I did see some research that pointed out that when the Fed does cut in intermeeting in an emergency situation, which it did 3 times in 2001 and another 3 times in 2007, 2008, both periods the move did not prevent recession. So that's something that we're also going to consider. The Bank of Canada followed today with a half-point cut, so we can see just the historical picture there of where we're at. But it's not out of the question that if the coronavirus gets out of hand, that interest rates could continue to be cut further, right?
Yeah, absolutely. I mean, and the bank even said so in their statement this morning at 10 o'clock. They are prepared to do more, and they'll do what they have to do. It's quite interesting that given the rally today, just anecdotally looking at the difference between bond yields, government bond yields, and the stock market. I mean, the Dow is up close to 1,200 points today, and the S&P 125. And bond yields, you would think, would be dramatically wider, but they aren't. 10-year yields, both in Canada and the U.S., are only up about 2.5, 3 basis points. And interestingly, Scott, is the spread between U.S. Treasuries and Canadian government bonds in the 10-year sector is damn near flat. It's about 5 basis points right now. I think the Bank of Canada personally has a lot more catching up to do, and will continue to ease aggressively, and that will weaken the currency, which we should mention is still our largest single risk to our portfolios. Our average client portfolio is probably along about 20% in US dollars. So over the past month, when we talked about our three models, in the fixed income model, we would include, say, the currency, and that actually helped us a little bit, and even more so today.
Yeah, and we've always said that having U.S. dollars in times of market distress is also some mitigating protection. One thing that I haven't seen is the Canadian banks following through with any cuts to their prime lending rates.
They did. I saw a headline Royal Bank came across, so I'm sure they've all cut by now.
Okay, because I was watching for that, but I hadn't seen anything. It must have happened quite recently. Anyway, so one of the things that we've always talked about is value, and one of the reasons that we were reluctant to be buying stocks recently were because of the price earnings ratio was at a record close to 19%. That has come down significantly, so it allowed us to feel a little more comfortable doing a bit of buying, getting some cash put to work. But there is the potential for considerably more downside to bring value back into play if investors decide they want to wait for better value, right?
Yeah, absolutely. And, things that typically, as you can see in this chart alone, it typically gets overdone to one side, it typically gets overdone to the other side. So getting back to some sort of top of a range is not really super value. It's maybe as we did, it's a place to put a little bit of money to work, but I think it's important for our clients to know that we bought what we thought was the right amount for that move, and are still keeping powder dry for a more draconian type move.
Yeah, and with full understanding that that uncertainty that is there. I mean, the Organization for Economic Cooperation and Development, the OECD, was sounding the alarm this week, saying that GDP growth could plummet to as little as 1.5%, which is about half of what it was forecast to be at the beginning of the year. So this is something that obviously we have to keep our eye on as the economic data starts to roll out as we head to the end of the first quarter and into the second quarter. What excites us? Well, as we were talking about last month, when we had this same call, the fear and greed index was up close to 100. It's come down a long way, and we've talked about this before, but we look at these buying opportunities when this fear gets extreme out there, and obviously we saw some buying opportunity last week and took advantage of it. But again, as you said, we certainly want to keep our powder dry for if we get further value and better buying opportunities. Okay, administrative stuff. Bianca wants me to make sure that everybody is aware that it is tax season, and I know she sent this email out with to all of our clients so that they know what dates they'll receive what tax slips. But she did want me to suggest that there are T5 slips that come from companies outside of Raymond James, Manulife for one, Equitable for another, TD as another, because we've used their high interest savings accounts for some of our cash equivalent holdings. So if you want to get a handle on that, and because they don't come till a later date, you may want to have a chat with Bianca or send her an email just to get an update on what she thinks your situation personally would be. And you all may have received an invitation via eVite to our High Rock Private Client 5th anniversary event, which is going to happen on April the 29th. And we will have our A special guest, our good friend David Rosenberg, who worked at Merrill Lynch when I was still at Merrill Lynch, but he certainly spent a lot of time working alongside Paul. And we're honored to have him come and speak with us, or speak with you, our clients, on April the 29th. So if for some reason you haven't seen your Evite, check your junk mail just in case it went there by accident. But if you need it to be resent, please don't hesitate to get in touch.
And Scott, too, if I could just add, just given the markets are likely to remain pretty volatile here, as we've seen over the past week and a half, we've communicated with some clients directly, but anybody listening to this video, if you are at all concerned or you have more questions about anything we presented today or the state of your portfolio, please contact us directly, and we'd be happy to meet with you or have a phone discussion or even a GoToMeeting webinar where we can go through your portfolio. But we all know that it can be somewhat unnerving when markets are this volatile, especially to the downside. And if you have any concerns or questions, please do not hesitate to contact us.
Absolutely. Absolutely. And we're all three of us are available whenever you need us. So just feel free to get in touch. All right. Well, that's it for this month. Thank you all so much for tuning in. Again, if you need anything, please get in touch. And on behalf of Paul and Bianca, look forward to having this same conversations with you at the beginning of April.